Hey, what's up, everybody? Happy Friday. Got here a couple seconds early, so I thought might as well turn the bad boy on and maybe hang out for a minute or two before we get kicked off. Just talk to you guys, see how things are going. And then we'll kick the session off in just a couple minutes. I'll add timestamps as we go. So if you want to skip through this random bullshitting part because I got to the desk early, then totally cool. Recommend doing so. Looks like we got Hater. We got James. James, what's up, brother? Good to see you, my man. I hope you're doing well. How's the trading week going? We saw a bit of a downturn today, which I have to be honest, it came a little later than I was expecting because of a lot of the tariff conversations with Mexico and Canada. We spent a little while actually talking about some trade ideas off of that. And one of the things I told you guys that I unequivocally would do is fade the market. And so I put on some short beta futures positions to take the market to the downside. And it was short delta, I should say, not beta. And it took a little longer for those to start coming in than expected. So interesting. Dejan, Travel, Lauren, great to see all of you. Cool. What time we got? I got 1700 Pacific time. So it is time to get started. So let's get into it. So the first thing I want to start with is actually a recap. And as you all know, this is now episode 4. We've talked about a few things so far, and we're going to recap all of them very quickly, focusing mostly on the last episode. But before we get into the recap itself, you already know the dealio. We get to start with a quiz. So first things first, are 2 quiz questions. The first quiz question is, how does IV, implied volatility, differ from forecast volatility? Who knows the answer to that? What is the difference between IV and FV? And the difference is pretty important in reality. What do you guys think? Right now, Thor is hanging out with us. He's actually seated in a heated blanket. So, he's doing A-okay down here. Reese says IV is implied by option pricing. Okay. So James says IV is the markets priced in vol. Okay, good. Those are both correct. So then how does that differ from forecast? James says forecast is what is expected to move based on previous moves. Good guess, but no. Any other guesses? Travel Ursel says spoiled. Yeah, Thor is a bit spoiled, especially because Mel and I, we don't have kids, right? But I mean, I'm still kind of super strict with him. He doesn't have a collar or anything, but he absolutely is made to follow orders pretty well. But yeah, still spoiled in different ways. Lauren says past for future versus future. That's not it. We talked about this last time. So think of it this way. We know that implied volatility is derived from the market, right? So then where does implied volatility come from? How do we figure out what to put into the market for us, therefore, then henceforth unto forever known, be able to price? Got carried away with those fun words. The question here, though, is where does IV come from? We know that it's derived from the market, so that means somebody has to input what we think implied volatility is. So where does that input come from? Dejan is the closest so far, by far the closest. Dejan says different pricing models. That's the closest. Reese says best guess based on standard deviation. Travel Ursula says historical. Raphael says volatility. Nice job, Raphael. Glad to see that you're jumping in and getting right into the mix. We know we're talking about volatility, so right on. Okay. this is a really important point. We're going to talk about this more, but oh shit, stop that. I try to use my pen and it like hung on to the little drawing pad. One sec. Let's get us recentered here. Cool. I actually fully expected this, which is why this is a quiz question, because this concept is actually very important. And we talked about it last time, but Lauren says BSM. That is incorrect. It's a good guess. Actually, believe it or not, BSM is how we get this. So if we think about, well, we can answer number 2 while we answer number 1. So first, answer number 2 for me. What is the one unknown input into a pricing model? What's that guess? Mark says extrinsic value. That's not it. Good guess. Travel says we obviously missed it last time. Definitely. And the reason why I think people miss it is because it's a really subtle detail that's easy to skip over, but it's an important one. Okay, beautiful. So Reese says vol, good. Lauren says IV, which is actually more correct, because for Reese's answer, and I know you're just typing quick, but vol can be different kinds of things. So Dijon and Travel, same comment to you guys. Vol is not wrong, but when we're in like a basics setting where we're working on getting the fundamentals down, this is where I try to make sure that we're using the correct language instead of common parlance, right? So you guys saying volatility, I understand what you mean. You mean implied volatility. That's just in common parlance. But the reality is there are lots of different kinds of volatility. There's realized volatility, future realized volatility, historic volatility. There's a lot of different kinds of vol. So in this context, the one unknown input to a pricing model would not be something like historic vol, realized vol. The one unknown input would be forecast, and the other acceptable answer is implied volatility. So forward looking, that's the key takeaway here, is we're talking about forward looking volatility. So now, how does IV differ from forecast? Really simple. Think of it this way. You go to weather.com and you see that it's going to be 50 degrees Fahrenheit. I guess I could just put a degrees. It's going to be 50 degrees Fahrenheit. You found that it's going to be 50 degrees Fahrenheit by going to a website and seeing what somebody else figured out based on whatever tools they have, the weather people, which they're not always super accurate. So who knows what fucking tools they have? Maybe they just do the rock outside the window thing. But joking aside, you going to weather.com is essentially the same as getting implied volatility. We're going into the options market and then we're just isolating all of the knowns versus the unknown inputs into the pricing model. And we're saying, what's the remaining number? It's a differential equation. So we just solve for the implied volatility component. That's where this number comes from. Forecast is akin to the weatherman or woman. I am completely gender neutral when it comes to weather people, weather persons. And the weather people, they need to go out and they need to look at their barometers. They might step outside and see if their head gets wet. The joking aside, what I'm talking about is the weather person is actually doing some sort of research to see what they think the temperature for tomorrow is supposed to be. So they're the ones that are forecasting. They're using different tools to create a forecast, and then they're putting it onto a website that you get to go look at. Okay, so now let's look at this in options context. Forecast vol is typically done by all different kinds of volatility pricing models. These are all of your different kind of Garshes, which there's eGarsh, EJ Garsh, There's Garsh plus jump diffusion. There's binomial, et cetera, et cetera, et cetera. There's a million different kinds of models. All of these different kind of entities are attempting to try to figure out what volatility should be. They are forecasting it. They're using and maintaining their own volatility surface model. This allows them to come up with their best estimates for what the implied volatility for each and every option should be. So the way to think about forecast, this is typically institutions or professional side traders and investors, really institutions typically, that are running analysis to actually try to price volatility. Whereas implied volatility is literally just looking at what an option is priced at and then backing out what the current volatility is based on the pricing. But the forecast vol is what's fed into the model. I'm going to take a pause here. We're going to spend more time when we talk about volatility getting into the weeds on this, but I do want to make sure that this concept is clear. Because the importance here is understanding the nuance when we're talking about implied volatility. The implied volatility is obviously based on current market prices. It's not based on anything other than that. Reese says, so forecast is just anyone's forecast. I could have one, you can have a different one. Yeah, that's correct. But let's say that, and again, the way that the forecasts manifest themselves is through the pricing of an option. When we're talking about the pricing of an option, it's really essentially us talking about volatility. Because if we go into an options chain and we look at the price of any of these, this is just looking at SPY. When we look at all of these different options, we know all of the individual inputs that are going into this options price. Let's call it the 600 puts. We know the price of the underlying. We know the yield. We know that it's an American style option. We know that this is a put. We know the days to expiration. We know the risk-free rate. We know all of these different details. The one thing that we don't know is implied volatility. Somebody has to determine what the implied volatility is. All of those other inputs essentially are knowns. So when we're looking at the price of an option, we're literally, I know it's kind of esoteric, it's hard to connect the dots for people on this, but we're pretty much just looking at volatility. We want to know what volatility is priced at. And it's because everything else is already known. So the only thing that we don't know, and the only thing that really this price is highly varied off of beyond those inputs that are standardized and known, is volatility. So this implied volatility column is literally just extracting out all of those known inputs, and we're seeing what's left. We're solving for volatility. That's all that's happening here. So to Reese's point before, anybody can forecast vol. So if I choose to go through here and I decide, well, my volatility model says implied volatility right now should be 11% as compared to this 10.72%. So in my model, in my world, this is low. So then I can make a bet off of that. Maybe I can come up with some sort of horizontal trade to play the relative value of the 600, buy the 600 option and sell the 600 option out in 11 Feb, 12 Feb, 13 Feb if there's some other expiration where it's too expensive. Or if there's an option in the same expiration cycle that's too expensive that I want to sell, I can just create a vertical spread. But the point being is, if I'm maintaining my own model as a retail trader, I can try to come up with some ideas here, but the reality is the market is probably going to price these better than any of us can. I've tried to maintain a model and sometimes it's decent, but the reality is, with as many market participants as there are and how much big money is in this, We're not going to price vol better than what the market prices vol. It's just the fucking reality. So then we, as the retail trading side of things, we essentially take whatever the implied volatility is and we say, this is probably pretty close to what it actually is. We don't know, but it's probably pretty close to what it actually is. So to recap that whole thing, forecast vol is actually doing the work of figuring out what the volatility of an option should be. Implied volatility is when we extract the market price of vol from an option. That's the difference. Dejan says, can I use gamma exposure to create my own vol forecast? Completely different things. Gamma exposure is just a entirely different concept than trying to forecast vol. The way that we forecast volatility, and this is why I use the weather analogy, it's not all too dissimilar from how we forecast the weather. And I use this analogy all the time because it's really good. I live in Southern California. Today it was 50, well, right now it's 55 degrees. So if I were to guess what the weather tomorrow in Southern California is going to be, specifically the temperature, if I were to guess what the temperature is going to be tomorrow at the same time, 17:15, what is my best guess? My best guess is that it's probably going to be something close to this. Probably something close to 55 degrees like it is right now. Probably. Now we could have a storm front move through and cause a massive change. In the volatility world, that's when volatility becomes transitory. But what we're talking about now is the propensity for volatility to cluster, just like weather clusters. And again, we'll get way deeper into volatility. I don't want to get too far down that rabbit hole in this session, but the main point is the way that we try and forecast volatility has a lot to do with looking at what the recent past looks like. And then we can use all different kinds of data injects, which is a big part of coming up with an accurate forecast model for volatility. It's not just figuring out how to factor in price shocks and things like that. It's also knowing everything about the stock. Is there any sort of news coming up that could potentially impact the price of this stock? And it doesn't have to be news that's tied directly to the stock. It could be news that's tied to an industry conference that's going on right now for medical devices. And the one company that is a supplier for medical devices can be impacted by one of the outputs from that medical device conference. Like that, and that's like a superficial example. It goes so much deeper than that to maintain, obviously, as accurate of a model as we can. So that's the difference between forecast vol and implied vol. Forecast is doing the work of trying to estimate what it is. Implied volatility is literally just extracting it out from the market. So let's clear all this garbage off. And let's take a look at a quick recap for episode 3. Like I said, we're in episode 4. So episode 3, and the reason why I don't show you this before we do the quiz is because there's some answers in here. Like the first one, options are priced by consensus. So this idea that we're using Black-Scholes-Merton model to then actually figure out how to price an option that's a theoretical concept. It's not how it's done anymore. It's done by all of these different entities from institutional side of things, figuring out what they think volatility should be priced at. All of them are interacting in the same market together that then moves the needle towards whatever market consensus is for what volatility is, thus what the price of an option is. We already talked about that we need a volatility forecast. I think we actually spent a while on that one. And we know that from a retail trading perspective, we derive implied volatility from the market. So there's lots of different pricing models. Again, we understand them and use them from a theoretical perspective, but from a practical application standpoint, none of it matters. Whatever is priced in the market is probably what the options are worth. That's the idea. Cool. Solid recap. Now we get into trader organization. Let me update our timestamps. So we're at 2240. Cool. It's taking me forever to type this because it's like off to the side on the like on the way that I'm sitting, which is actually kind of funny. So let's talk about this idea of trader organization. Now, as always, from military learning style, we always start with TLOs, ELOs. You don't get ELOs because I don't care about them. I care about TLOs. And this is the end state. At the end of this session, you should be able to complete these 2 tasks. The first task is to create your own millionaire roadmap, which we talked a little bit about in the planning section earlier on, but we're going to touch on it again quickly. This is just a name for a plan. I literally just call it that because it's a catchy name. It can be whatever number of dollars you want it to be. This is what we studied in the skill development session last week, is this idea of creating a broader plan. Then the second thing you should be able to do by the end of the session is to be able to begin creating your own trading plan and supporting trading log. So we're going to talk about those. So the first thing, why do you care about this? Why are we talking about this thing? This isn't like this sexy part of options trading. That is really, actually, if you think about it, kind of the boring, ugly part of options trading. This is why we talk about it. We talk about this because of Blue Waffle 135 from 3 hours ago. I sold a cash secured put on NVIDIA the day before it crashed 20%. They sold a 135 cash secured put 30 days out for 200 at a 25 delta. Now the cash secured put is at a unrealized loss of like $1,500. How screwed am I? What do I do from here? This is exactly why we plan to not be in this scenario. This is not a giant deal, hopefully for them, but the reality is for people, the vast majority of options traders, this is what they do. They just start putting on trades and then they wonder why the shit doesn't work long term for them. So going off of this concept, this is a post that I made that talks about some different stuff. I want to highlight this, the third bullet point in here. The concept of this post, and this will be in a newsletter at some point. The concept of this post is what I consider to be some of the larger failure points for options traders. So the reason why we talk about the failure points of options traders is so that we understand what a lot of the common issues are so that we can do something else. Because as we talk about with respect to trading, if you want to be successful at this long term, you literally have to be a statistical outlier because the majority of people don't do it. So we need to understand what they do and then not do that. So this is one of the things that they do. They exhibit disgustingly common lack of planning. And we're going to talk about how to create organized planning across this whole breadth of things. But the first reason why you care about this is because this is what the majority of people do, and this does not work. That's why. The next reason why you care about this is because when we're trying to figure out how to trade options, we're interacting with a very complex system. Markets are complex, options are complex. We as traders are complex. You have all of these different levels of complexity and all of these different interfaces. There are a lot of variables. It is very difficult to confidently track and know which ones matter and how much and how to manage them. So that's why I think this is worth your time. So let's talk really quick about some common misconceptions and questions. I shot this out and I got a few of these in, so I just threw them in here. At the end of these, you should have an answer for every single one of these. How do I know what I need to track? I don't think I need a written trading plan, and I don't know how to make one. So we will cover all of those throughout the sessions. If there's any other things during this session that you want to highlight or hit, please throw it in the chat now, and I will add it to this. This is our guidepost. Again, at the end of every single time we meet for these Friday sessions, you should have answers to everything that's here. and you should be able to do what our TLOs say you should be able to do. Otherwise, if that's not the case, I massively failed you, and I don't intend to do that. So if there's anything else that you want to make sure that we learn, that we discuss along the way, throw it in the chat. It'll get added to this list. Now, while you're doing that, we'll start with overviewing the key documents as far as my mind is concerned. And it's these three things. So on the very far left-hand side, that's actually a screenshot of my actual trading plan. And as you can see, it is really nothing special. The very top of it is just this disgusting yellow text on white sheet of paper. There's nothing special about it. I'm highlighting that point purposefully. What it looks like doesn't matter at all. Hey, that's what I tell myself all the time. Makes me feel better. But this is actually true. Like, what this looks like really doesn't matter. What matters is what information you can extract from it. The second thing on this list is the millionaire roadmap. So I'm throwing a link in the YouTube or in the chat right now so that you can see that video. That video walks you through step by step, literally how to create your own path, whatever that path is. And what I mean by that is, if we pop over to the website, last week we talked about the money mindset exercise, and we talked about trying to find a way to figure out how much money we need by what point in time in order to hit that financial freedom threshold. So then we need to then plan for that. So then if I'm a trader starting with $25,000, I'm saving $2,500 a month because I'm a real good saver. I got 20 years to go using a standard market return of 10%. That puts me at 1.8 million. Then we can figure out if that's enough, depending on how you intend to withdraw your money and stuff like that. You have to go through this process for yourself to figure out what these numbers are. But what's important is this number, this number, this number, and this number to start. Meaning, what is your starting investable principal? How much can you save? How much do you think you need in order to be financially free? What time frame are you trying to do it in? And then we get to take a look at the rate of return as we become traders. You don't get to change the rate of return up front if you are a new trader. You don't get to have this. It's the same thing as if I am a brand new basketball player and I step on the court for my first basketball game. I don't get to say, like, I'm going to drop 30 on their heads right now. Well, we'll see how it goes, right? Not playing in that competitive level previously, that may be possible, may not be possible. So I can have an idea of what I might want to do, but the market return is a great planning factor. The reason why I emphasize this point so heavily is because one of the most dangerous things traders do is they say to themselves, I'm a new trader, I'm 2 weeks into this. If I'm going to bother learning to trade, it should be worth my time. I determine it's worth my time if I'm able to make at least 30% per year. Well, guess what? One, you would have that's 310. I was going to say, like, that's a lot of money. You're still going to have a lot of money if you got that 30% per year. But the point I'm making here is, like, it doesn't matter what you think you deserve. No, literally nobody fucking cares. What matters is what your skill is able to produce. Going back to the basketball analogy, doesn't matter if I walk on the court in my mind saying, I'm going to drop 30 on their heads, and then I'm out there shooting like Shaq, right? There's a big disconnect. It doesn't matter what the fuck I want. What matters is what I can do. So one of the big issues new traders have is they set themselves up for these crazy ass initial returns. And then in order to try to hit them, you have to place big trades. Not ready for big trades, probably as a brand new trader. So that's the issue that typically opens up here. So that's the second thing you need, is that roadmap. And you need to have an understanding of where you're trying to land. And then the third thing is a trade log. This is a screenshot of one of the trade logs that I've been showing you guys for a while for the covered strangles. And I actually have a video that's coming out. Technically it's coming out next week. Maybe we'll do it this week. What do you think? I have a video about trading Bitcoin with options, and then I have a video about tracking your trades like a pro, building a trade log. I'll switch these really quick because I think it makes more sense to do the trade log video this week. So that will go there. This will go here. So now there will be a trade log video that's coming out on Sunday. And the trade log video is going to go through pretty much all of this through not incredible, through pretty significant detail, especially compared to what most people are probably used to seeing. So these are the documents that we need. Now, a common question is, how do I start? How do I start making one? I'll show you. I'll show you exactly how you start making one. What you do is you go to google.com or a Word doc and you open up a Word doc. So this is a sample trade log template or trade plan template. All you need to do is start writing words. You start writing words, you now have a trading plan that's a work in process. The reality, as we build these trading plans in trading logs, they are iterative. That means they are going to change continually. They continue to change. Right now, it's really difficult to see because this is like tiny text, but right now my trading plan is 415 pages. It continues to change, adapt, grow. The thing to remember is I just wrapped up my 18th year of trading. I've been doing this shit for a long fucking time. So that's why there's so much stuff in there. So now we have an idea of why this matters. It matters because most traders just start trading, it doesn't work, and then they don't know why. This is typically why. The key documents that we're going to use are a plan, and it's not really a document. This is like the guiding concept of what we're doing. Then we're going to have a trading. I call it an investing plan because there's like stuff in real estate and shit in there too. It's not just trading, but call it whatever you want. You need a trading or investing plan, and then you need a log. So let's talk about the relationship between these things and why this is the order I think it makes sense, which is something like this. 1, then 2, and then 3. So we start 1 with our goals. We create our goals by completing something like the money mindset exercise that we did last Wednesday together on YouTube Live together. And then we take the money mindset exercise and we feed that into our millionaire roadmap. The millionaire roadmap then tells us, we say, I want $2 million within 20 years at a starting principal of 25K with savings of, I don't know what the numbers are to work out to 2 million. I'm just coming up with shit. With savings of 1,500 per month at a 12% return, whatever the standard market return is that you want to reference off of. We now have some very clear details on what we need to build. We need to build something that can return this, provided that we can maintain this, and provided that we're still okay with this. This is why the money mindset exercise feeds into the millionaire roadmap, because the money mindset exercise tells us this. How much money do we think we need? And then the recommendation I give to people is to have 2 numbers, the MVP and then target or goal. MVP is financial freedom. The target is what you want, what you desire. So maybe our MVP instead of 2 million is actually 1 million. The way to think about the MVP, this is where you, at least for me, I want to take a giant step back and say, this is just how my fucking brain works. I'm not saying that this is the right way for everybody. I'm just giving you the shit that I know. That's all I can do. I'm not a professional in any of this space. I'm not like a fucking trading coach, just talking to you about my experience. And the MVP, the minimal viable product here, financial freedom, the way that I planned for this in my mind was this is when I'm at my job. And if my job asks me to do something that I don't want to do, I can say no. And I can say no comfortably. And then if they press me to do this thing that I might not be comfortable with doing, then I can simply say no and then deal with the consequence. The point I'm highlighting there is to have control over yourself, like autonomy, the ability to execute your life in the way that you want. Because when you need that job, because you have family at home, because maybe it's during COVID, it's a tough job market. So your boss is asking you to do something that you don't really want to do, but you're like, fuck, I have kids that I have to take care of. I have a wife who's not working right now because she's staying at home with the kids or whatever. And the job market's really bad. So it's not like I have a bunch of other things I can pivot to. The boss has asked me to do something that I really don't want to do for whatever reason. And I'm just going to say yes, because it's safer for me to keep my job. Now, there's varying degrees of that, right? And I just want to be clear, you have to figure out what the line is for you, right? Like if your boss asks you to do something that just like mildly irritates you because it's annoying, well, get over it, bitch. Like that doesn't matter that much. But if it's stuff that like you dread going to work, it's soul sucking. Think of what a terrible way to live the bulk of your life on a day-to-day basis, doing something that's fucking soul sucking that you don't want to do, but you're doing it because of these obligations, because you're a good person that's delivering on these obligations. But I'm here to happily tell you there's a better fucking way. You don't have to do the soul-sucking thing forever if you plan out this shit. So MVP, minimal viable product, that's really from the tech world. This is when we initially cross the threshold of being able to have true autonomy over ourselves. We should still continue working. We should still continue working. But if there's some big moral thing that you just don't agree with and you're still planning on going to find another job, but you can stand on your morals in the current job and accept the consequences, that's financial freedom. Then the target is being able to do kind of the cool shit that you like. A great example of MVP versus target desire. MVP, like I talked about, being able to say no at work to something you don't want to do. Target desire is you want to travel 6 times a year. Every time you travel, you prefer to fly first class. I sure do. It's way more comfortable. That's super expensive. And in general, first class is probably one of the worst possible uses of money beyond the comfort that it provides. So that comfort is at a true premium. You can still travel 6 times throughout the year. But if you add the requirement of wanting to travel more comfortably because that matters to you, that's a desire. You don't really need that. You can still travel without it. But I can tell you unequivocally, it's so much fucking better with it. So much better. And it's not because like the free drinks and booze and stuff, like the seats being a little bit bigger is nice. That's a big thing. But it's also you don't have to like worry about the fucking overhead bin space. That's one of the most annoying things because both my wife and I, unless we're going on like a dive trip, we just carry a backpack. We don't do checked bags because you don't need that much shit for the vast majority of stuff. And to like have to worry about if there's going to be enough overhead bin space, like fuck that. I literally will walk on the plane last because I get to stay out of the plane longer. And then I know there's going to be overhead bin space for me. Like it's little shit like that. But again, the point I'm highlighting is it's still entirely possible to travel just fine and worry about the overhead bin space, but you can make it happen. This is the difference between a target desire level metric to account for things like that you figure out from the money mindset exercise. And MVP is simply when you have your financial freedom. So that's the goal setting section. Now, that goal setting section, as we talked about, gives us some really important takeaways. So one of those takeaways is this return over here. We know what we need to hit. Okay, great. Now we have a planning factor. So then where does the trading plan come in? So step one, to reiterate, is goals that are quantified. Step two now is creating a plan. The purpose of the plan is to figure out, this is going to blow your mind, figure out a fucking plan to hit that 12% metric. Or that's the example that we have from the goals was 12%. It's whatever it is that you think is possible and whatever you're targeting. And guess what? As you're going through your plan, you might realize that this is doable or this is not doable for you. Or you might realize as you're trying to build what this might look like, the way that you thought you were going to do it might not work. That's the point of the plan. So now let's talk about the key sections of this plan. Where is, oh, hold on one second. Perfect. So the first section of the plan, and you'll see in the template that I have, this is something I use somewhere else, but for the plan itself, we're going to have some key sections. We're going to capture our goals that are quantified. We're going to include the millionaire roadmap so that we have a clear target of what we're shooting at. Then what I like to have is kind of a portfolio management section. This is going to include my risk tolerance. Beyond portfolio management section, this is when we get into the actual tools. So that will be stuff like profit mechanisms. This will be stuff like analysis. I personally have sections for market function. Well, market history and function. In a practical sense, I don't think you need this. I'm just letting you know, like, that's actually why you see this, right? So this is talking about market execution, what open outcry was, how electronic exchanges grew, and all that kind of stuff. I have an obsessive personality. When I'm interested in something, I learn everything about it. So that's why this shit's in there. You don't need this. Then after this, we have strategy outlines. And then after strategy outlines, we should have some sort of AAR process. And we should have RFIs. AAR is after action review. This is another military term, but this is when after we conduct an operation, we conduct a mission, we look back over it and we say, how did it go? So we need to have an AAR process to do that literally for our performance. Then RFIs, requests for information. These are ideas that you have on things that you want to try to iterate on. Maybe I want to explore doing a 30 delta short put versus the 40 delta short put. And you can take notes on this stuff. The reason why those notes are important is because when you do this for a long time, after a while, you'll start to have questions like, have I tried this before? And you will be able to answer questions like that to be way more efficient with your time. Now, within strategy outlines, This is a standard format that I use. Exec summary, setup, management, tracking, RFIs. How are we doing so far? These are the elements, literally, of a trading plan. We can look at how to build this together. That's the goal. So let me grab, I'm literally going to open up a blank Word doc. Like I'm literally going to like straight up do this shit with you. What do we want to do? Here's fine. So we'll just do a blank Google Doc. We can all agree that this is about as blank as a Google Doc can be. There's nothing in here. Oh, that's actually kind of cool with the tab stuff now. Here's literally, I'm not kidding. If you don't have one, I literally would love for you to just do this with me right now. You can start it right now with me. So let's essentially take what we captured over here and put it into our log. So the log title, trading plan, whatever you want it to be. Now, for me, in mine, we are going to have a handful of sections. So what I'll do is I'll use a couple heading sections. We'll start with the title of the doc. The title doc will just be investing plan or trading plan, whatever you want. And then again, for me, I typically have a quote. The reason why I have the quote is it's just a reminder for when I click into this. There's a few of them. So the first one is, that's something my mentor used to say to me when I used to have different feelings about trying to make a bunch of money. He used to say to me, money can't buy happiness, poverty can't buy shit. So the lesson behind that is money is an amplifier to your life. It can help a lot of things, but if you as a human being are a nasty, ugly human being, not in terms of your looks, obviously in terms of your character and personality, money ain't gonna fix it. If you're a good person that has a beautiful human being, like in totality, money is just an amplifier. So that's the first thing. The second thing is this. Financial freedom enables true freedom and expression. The reason why I put this in here is because it reminds me not just that making money is for the sake of making money to go buy cool shit. It's that money literally allows you to be unabashedly yourself, period. Whatever that is, hopefully it's a good person, but it allows you to be exactly what you want to be, who you want to be. You do not have to tiptoe through the tulips with people to make them think that they like you to try to get a promotion. You get to be yourself. If there's some sort of cause that you really care about, but you're concerned what your workplace might think about you if your workplace has a different disposition than your disposition, and you don't want to go apply to this cause or help this cause because of that, that sucks. So that's the idea here. So now you literally have the first section of your trading plan. Now let's get some headings in here for these other sections. We need goals, not foals. We need goals. And the reason why typing is hard is because the keyboard's like off to the side here. Millionaire roadmap can go in here. We need portfolio management. We need profit mechanisms. We need analysis tools. If you're a nerd, you can have stuff here for like market functions and history. And then we have strategy outlines. And then we have AAR process. And then I normally will have RFIs near the top, or I will have them in like a separate Word doc or notepad. I don't keep them necessarily in the plan because I don't crack open the plan every single day. Now, why did I use headings? I used headings because it puts them over here so that as your document becomes 400 plus pages, you can click at them and it'll just take you to where you're trying to go. One of the things you'll notice about the way that I do things is with an obsession over efficiency. And it's something that you learn over time. You don't have to get bogged down in those details early on, but there is a reason why I do most things the way I do most things. And I'm just giving you the Cliff Notes version why it's like this. So now we have literally the start of a trading plan. You just started a trading plan. We now need to figure out and fill in these key sections. So for our goals, I'm not going to fill in all of them because it's going to take too long. But essentially, we know that we want to have 12% target. We already have the details from our millionaire roadmap. You could take a screenshot, drop it in there, whatever makes you happy. Portfolio management. There's a couple key sections here. The very first thing we need is risk tolerance. So this means of your total portfolio, how much of it are you willing to not see anymore in pursuit of this? The way that I explain this to people is we have to take risk in order to get to a reward, this reward. In the military, we use a process, an ORM process, operational risk management. What that does is it makes sure that I'm not taking unnecessary risks or stupid risks that don't have a commensurate reward associated with them. So here's an example. Let's say that in my initial thought for my risk tolerance, I'm like, I'm okay with a 50% drawdown. Maybe I think that genuinely, and that's my initial idea. Well, let's take a look and see if that's actually the case. And I'll show you how we can do this. There's two things that matter to us here. The first thing is let's go back to this. We can get rid of all that stuff. Let's go back to this. We had our scenario where we had like $2,500 or 25,000. I think we were saving 2,500 per month. We had a 20-year runway. Yeah, so this is where we were. So I say I'm okay with the 50% drawdown. So let's see if I'm okay with the 50% drawdown. Right now, it would take me 20 years to get to 1.8 million. If I click into this, it's 20 years to get to 1.8 million. So am I okay with a 50% drawdown with a small account? Of course. Why not? A small account is going to be completely dependent on these savings. Now, let me show you another example, though, to help you understand this broader point. That's why you have to look at the numbers, because the numbers matter a lot. Let's say I'm saving no money, and then I do the same thing. I cut the account in half. We go to 12.5. 20 years, I'd have 168K. In 20 years, I have 84. So for a small account, if you are aggressively saving, you can get away with more of a drawdown. That drawdown becomes a bigger problem as your account gets bigger, because then the incremental saving contributions don't matter as much if you have a big portfolio. So let's say you have a $500,000 portfolio. You have like a mid-sized portfolio. And let's say that you're not saving any money at this. Well, let's actually say you are saving. Let's say you're saving $1,000 a month. Notice the difference here. So for a $500,000 account, saving $1,000 a month, 20 years, you have 3.3 million. If I add this, you have 4.1. Still a big change. But in the other scenario, the change obviously was multiples of the initial amount. So this incremental saving doesn't help you as much. So now let's cut this $500,000 account in half, maintaining the savings. 20 years, 4 million. 20 years, 2 million. Do you see the point? The point I'm making is that with a small account, your savings matter more. With a bigger account, or as soon as your savings comprise a smaller percentage of the total account value, the drawdown matters a lot. So now in that same time frame, I have half the money. Probably not what I want. So then going back to this trading plan idea, this is how we actually assess our risk tolerance. It's not just a random number. It's not just sitting there thinking like, oh yeah, fuck, what would I, it would suck to see the portfolio at whatever. That's not it at all. It's seeing how different drawdowns impact your actual trajectory and your broader plan. I'm going to pop the door for Thor. Mel is at the gym right now, so I suspect he will be back in several moments when he realizes that she's not there to feed him dinner. LOL. Does this part make sense so far? The risk tolerance. Then from there, I split my portfolio. Core allocation, speculative allocation. And then based on your strategies, you have to figure out how much each of these could potentially make. In the beginning, you don't have to worry about any of that. You need to figure out your risk tolerance, and you need to figure out a portfolio circuit breaker. This essentially is the point where, let's say you decide that your risk tolerance is going to be a 30% drawdown. Your portfolio circuit breaker is going to kick on at like 25%. If your entire portfolio value is down 25% in proximity to your total risk tolerance, the portfolio circuit breaker is designed to get you to go in there and start cutting fucking trades before you get to your risk tolerance threshold. This is how we stop catastrophic drawdowns of accounts. Then you can go into broader portfolio utilization rules and shit like that. Profit mechanism. I have a video that talks about this. We're not going to dive into the detail on profit mechanisms here. That's one video about profit mechanisms. Guess who's back at the door? I fucking told you. So funny. It's almost like I know this dog. Here's the second video that talks about creating a strategy. But profit mechanisms are the things that you expect to make money from. He came back in real quick. So this can be something like beta drift. So this can be like large cap. And I would define it. So beta drift in this context would be propensity for large cap stocks to steadily grow over time in an expanding economy. And then what I would do is I would list research. Where do you find the research? Great question. From SSRN. That's the starting point. Another great example here is momentum. This is well documented. And so on and so forth. I would list out the different profit mechanisms I'm intending to trade. The analysis tools, I would break this out to be guiding concepts. Then I would break it out into technical. And probably spell technical, right? That would be good. And then fundamental analysis. And then I would also add things like market analysis process, economic or economy analysis process. And realistically, these would be switched for me. You could even see as I'm filling it in, like shit moves, right? And these would be literally a list of analysis tools. Then market function and history. This is just that optional note stuff. And then strategy outlines. Let's do one example of this. So we can have, and here's where I would actually use subheadings so that they'll pop up underneath here. So maybe we have a covered triangle. And then within the covered triangle, we already know the sections we're supposed to have. An executive summary. We need a setup. We need a management. Lauren says, are there better strategies for smaller accounts? Well, as you know, better is relative, but I actually just put a video out not too long ago about trading options with like a $5,000 account. Here's that video for you, Lauren. There. Management. We need a AAR process, and then we need RFIs. Now, I want to linger on the strategy outline specifically. The reason why I want to linger on this is because this is where the trade log gets introduced. Because the executive summary for a strategy, and for those that don't know, I have a video that talks about trading plans in depth, like pretty far in depth here. So you can check that video out whenever you want. It'll go through all this more in detail. The goal for this video is to be way more practical and talk about literally starting your own like this with me right now. So the executive summary, this is literally just a proof of concept. You should be able to summarize what the fuck this thing is supposed to do, this strategy is supposed to do in like 2 sentences. If you can't do that, it means you don't know what this thing is. So this is just a proof of concept to make sure that you know what this thing should be doing. So for example, the coverage triangle in this context could be designed to capture market beta or leveraged market beta and amplify returns using short options, calls, and puts. Done. Setup. There will be different sections in here. So the first section, subsection, and again, this will be whatever you want it to be. It will take shape over time, but literally think about just the process of putting a trade on and the shit that you need to do in order to put on a trade. So the first thing is you need to know the structure that you're going to use. You need to know the profit mechanism that you're trying to capture. You then need to know the product universe or the security universe, the things that you might trade. You need to know things like how you plan to set money aside for the strategy, and so on and so forth. Then management is exactly what it sounds like. It's talking about how are you going to actually manage the trade. After action review is what are you going to look at to see how you performed. So now this starts looking like details that are important for a trade log. So if we take a quick pause and we take a look at a trade log, this is again just like a sample trade log. There's a video that's coming out Sunday that will go through all this way more in detail. But we can take a look at a strategy, for example, in a trade log here. And this is for what? A coverage triangle. So this is like an old coverage triangle tracker for, this was just an example. And when I'm thinking about how to build something to actually track, I need to start with the details that simply matter to the strategy. So think of it. What matters to the profit mechanism? Well, the first thing that matters is the ability to assess or track if there's drift. So I'm going to list out the metrics that are important, metrics that are important to strategy success. One of those, underlying price movement. That's a big one. You can then go through and think, if you were to click the button to enter a trade, what are the things you would look at? Things that I would look at are like, I would look at the ticker. I would look at expiration. I would look at strike, delta, premium, so on and so forth. This is literally how you decide what should go into a trade log. Notice how all of this is beautifully aligned with your initial goal set. Your initial goal set is to make 12%. We have a portfolio that we're going to try to control risk in pursuit of the 12%. We're first going to start with whatever our comfort levels are in terms of drawdowns, but then we're going to see if that actually can work based on what kind of profit mechanisms we understand we're going to try to trade. Then, as we look at the individual strategies that we're going to try to trade, we start to have a sense of how much money we need to use. How does the underlying typically move in whatever the kind of strategy is that you're trying to trade? And then what metrics are important to include in a trade log so then you can analyze the performance of what you're doing. This is it. This is exactly what I think traders should do to create a unified plan. Starts with goals. It goes into a trade plan to outline your ideas. Then we figure out of those ideas, we figure out what strategies we think we might want to trade, and then we start looking at a trade log. Now, as we're trying to figure out a key question, how do we get to this 12%? Well, that's going to be based on what's in here. What are your strategies? What do you do? And based on what's here, that's going to tell you how much money you might need to use at a given point in time in order to prospectively be able to hit that 12% return. So for example, the coverage triangle is designed to capture market beta, just standard market directional movements. We can amplify it with some leverage if we trade a leveraged ticker associated with it. I tend towards ETFs personally. So if the market has a down year, guess what that means for the coverage triangle? It means it's not performing well. Now, the coverage triangle will still perform better than just buy and hold in the market, but that doesn't mean it's going to give me this in a down year. So now I have an RFI. One of my questions I'm going to have to solve for at some point is, how does this fit into my portfolio utilization during market down years? Now I have a question I need to go think about and try to solve for. So on and so forth. Now, the AAR process, I think I have, I don't know if I have videos. I'm pretty sure I have videos. We probably did it on a live stream. The AAR process is like a review process. So what I do is I have a weekly, monthly, and annual review process. And in this AAR process, I literally just outline the steps that matter to me for the review process. So the first step is portfolio, track market, for an assessment between the two. Track strategy utilization, so on and so forth. So the AAR process, I outline it so that it's not a unique unicorn every single time I do it. And the thing that you'll notice is that, and this is why I talk about the process of trading and the process of building things on the back end to support what we're trying to do as a trader. If you build the back end process, the function of actually trading literally is easy because all of the work is done here. So then when we go back to that other example from Reddit of this person, guess what? If we have a plan, we already know the fucking answer to this. There is no go to Reddit and look for help on what to do. We've thought through this because this is part of the plan. We're talking about up here, the management. The management cycle for a trade includes how risk management approach, profit management approach, time management approach, and so on. This is it. If you followed along and you did some of this work with me, congratulations. You literally just started your very own trading plan. And that literally is huge. It might sound insignificant, but that's a huge step in starting to build something that's logical, scalable, that's not based on randomness, that's actually purely decisions that are made on information, not pure randomness based on what you happen to feel at a given point in time. Any questions on this idea about trader organization, goal setting, trading plans, trading logs, anything like that? The key takeaway from this is the most important part of this is starting. And if you start the process, it's iterative. Don't get overwhelmed not knowing what to track. What happens to a lot of people is they don't know what to track, or they say they don't know what to track, so then they just don't track. That's a bad answer. The way that we figure out what to track is trying to logically think through the inputs that we use when we're making a trade decision, and then creating areas for us to track those inputs. So then we can see if it's something that's relevant, that matters, if it's something that doesn't matter. N54 says, makes sense, we're all running blind. Yeah, the vast majority of people do. The vast majority of people literally just start trading. They somehow hope that it's magically going to work out, and it's fucking crazy. It's literally the dumbest thing on earth. And I'm not calling other people dumb, because guess what? I'm the same fucking idiot. I did the same shit. We all do it. And it's because we're all grossly misled at the onset of what this whole trading thing is going to look like. But yeah, it's these kinds of things, once you see them and you understand them, it's kind of like, fuck, kind of makes sense. It's actually kind of silly to not do this. The equivalent of not tracking these kinds of things is, it's like, imagine you're a stock holder, you hold Apple, and then you get on the earnings call, and then they ask, hey, Apple, how'd you guys do last quarter? And Apple just goes, well, I'm not too sure. It felt like it was pretty good. We had some pretty good ideas. We tried some of them. I think the new iPhone might have get rid of this damn extra camera button that nobody likes. I think maybe we could do that. Not really sure. And then somebody's like, well, got it. So how many phones did you sell? I don't really know. Oh, curious. How many computers did you sell? Not too sure. Maybe like 1,000, 2,000, 5,000. Not positive. How much did you sell them for? Well, it kind of depends on where I sold them, right? You see the point. Like, imagine a business trying to do what we do as traders. And again, trading at a professional level, it's a fucking business. Now, the thing that I will always remind you, the beauty of all of this is that the reason why the opportunity exists as it does is because most people don't do this stuff. So it means that it literally is not overwhelmed with tons of people that are in here with, all different kinds of ideas, trying to extract all kinds of market opportunities. Most of them can't even get to the market opportunities. They can't get out of their own way. And that's not me wishing that on anybody. It really isn't. If anybody knows what I'm about, shit, I'm sitting here on Friday night talking about shit that I've known for nearly 2 decades. Clearly, that's not me. My hope genuinely is to try to help other people avoid this really silly, unnecessary path that the majority of people take. That's my hope. So that is my TED Talk. That's what we have for Trader Organization. You now know how to create a millionaire roadmap. You understand, and you started to create your own trading plan. And you're able now to create your own supporting trade log based on the inputs we talked about you need to capture by outlining what matters to the individual strategies. And then there's a video coming out on Sunday that's going to go into trade logs in detail. So you can tune in for that one so that then you can figure out over the next couple days what kind of strategies you run, what kind of metrics are relevant to that strategy, and then spend today and tomorrow brainstorming on that, writing that out. And then as you're sitting there saying, well, I don't know how to fucking do this trade log thing, then boom, Sunday, the light will shine down through the clouds and there will be a video for you about building a trade log. And the video, let's see, the video is 25 minutes long. As we all know, it's pretty, your boy goes a little deep sometimes, but just kind of what it is. Cool. That wraps us up for this. If there's any just general Q&A, anything from a beginner level perspective that you want to talk about, now's literally the perfect time to bring that up. We can cover literally whatever you want. And while we're doing this, I'm actually going to do a little bit of homework, which my homework is to update our recap, what we talked about. I like to do it right after we talk about it so that it is the freshest in my mind. And as you can tell, what we're going to do is have a list of these so that they will all be in the same spot forever. So we'll be able to look at all pretty quickly together. So what questions do we have? Like I said, anything, it doesn't have to be related to what we just talked about. Anything from a beginner level is totally cool. So this was trader organization. This was what? Option pricing. This was buying versus selling. This was 101 recap. So now what we learned, we figured out how to create our own, oh no. Millionaire road mapping process. Creation of trading plan, outline, and key sections. And then we talked about determining the key metrics. Jesus. To track from the plan in a trade log. That will be our recap for the next one. I think we can kill this thing. Let's see. Tommy says, your thoughts on Elon saying there's a path for Tesla to being 20 trillion company at an earnings call? I mean, I don't disagree with him. I think objectively there is what we would consider like a path. I think that that's a fair statement overall. I just think it's a little bit of a reach, but it doesn't surprise me, to see him say something like that, especially with the total potential impact that Tesla might be able to have longer term, and depending on how it evolves, because that's the other reality, is that Tesla is probably going to evolve significantly as the rest of the market evolves. So yeah, I mean, I think it's a little dramatic, but also for a kind of guy like you kind of accept that that's how he's gonna talk. That's what he's gonna be about. But I mean, Tesla as a company has looked a little bit rough, I think. The volatility in it has not been very good. Yeah. Actually, it fell down below this, funny enough. Decent earnings, though. Brandon says, well, I'm learning options, so we should track every trade made when DCA in an uptrend and write down the reason why I bought it. Well, it depends on what you're trying to track, right? So like if you're doing like a long-term investment, there's not really a whole lot to track in terms of rationale, provided that the rationale remains the same. Now, if it were me, what I would do is I absolutely would note when I chose to buy in. But if you're buying in on a regular scheduled dollar cost average cadence, then you already know the reason. I wouldn't necessarily log that specifically. I would have a note in the log that says standard entry is blank date with blank amount of money. And then if there's a deviation off of that for some reason, I would absolutely track that. The other thing I would track for that kind of position is whatever frequency you analyze the position, meaning if you look at it on a quarterly basis and you're like, do I like this position still? Do I not like this position? And how do you determine how you like the position? I would track that. So let's say for the last quarter, you track things like, again, if it's a dollar cost averaging position, I'm assuming something slightly longer term. So something I would track are the earnings. I would say, what was EPS? What was the reaction? What was the movement over the last earnings? And again, you can come up with some pretty good trade ideas based on that. You can start to get a sense of your different holdings, which are performing best over on a quarter by quarter basis, and is there a relationship to what the earnings report is, and then that can really inform how you funnel your money going forward. So yeah, the thing is it stuff like this is whatever we want it to be. But what I can tell you is that if we're trying to make as much money as we possibly can, we have to think of it from that lens of how can I make as much money as I possibly can from this? And there's a process that we can logically follow to do that. It does require some effort though. And I think that's the rub for most people, is that once we start looking at that effort side of things, it starts to look real sketchy, real ugly, as it were. Sweet. All right, gang. Looks like we got no more questions. That's all I got for you. If you need anything, you guys always know you can hit me up. Happy to help however best I can. Be an outlier. We'll see you all later.